Hi everyone, welcome back again. Today we are going to discuss on one of the very important and very simple strategies, option spreads. We have various option spread types: debit spread, credit spread, ratio spread, double ratio spread, lizard, double jade lizard. So we will see various topics around these spreads, and we will do it in part 1 and part 2. In the part 2, we'll back test these strategies using Abstract Simulator for various market condition in the real-time market, and we'll see how do we do the basic adjustments, advanced adjustments, and out-of-box adjustments to increase our returns. I think you would have seen how we made 10% with out-of-box adjustments in the month of March with other strategy called Ironfly monthly, weekly, and weekly alone. With the low weeks environment, we were able to achieve 10%, and we did not, become aggressive. We did it very cool and very calm, and still we are able to achieve 10%. If the premiums are good, we can also achieve more profit or more ROI. Coming back to this topic, in the part 1, we'll discuss why we are going for spread, what are the different types of spread, when to take which spread, how do we create the spreads, and what is the capital required. When our view goes wrong, how do we convert one spread type to another spread type? Why spread? So these are the some of the reasons why we go for the spreads. So mainly the capital required is very low. You can also start from 30,000 for the basic spreads like debit spread and credit spread, and you if you go for the little advanced spreads like ratio spread, double ratio spread, Jade Lizard, they will they require more capital like up to 3 lakhs per lot or 2 lakhs, and if you do for double ratio spread it is 3 lakhs, and we have a techniques to reduce that capital from 3 lakhs to 2 lakhs or from 2 lakhs to 1 lakh. We'll see that during our back testing in the part 2. Okay, and other reasons why we go for spreads, and it's very simple to deploy and adjust these spreads compared to other complex option strategies. And based on market views, we can create different spread types. We'll see how we do that. If there is a breakout, or if there is a news based trends, we have a different spread types. We'll see how do we create that. And if the market is trending a range bound, a trend to the range bound, a range bound to the trend, we can create spread types which is convenient or suitable for market condition. And when our view goes wrong, we can convert from one spread type to another spread type to get the profits. Okay, these are the different types of spreads that we have: debit spread, credit spread, ratio spread, double ratio spread, Jade Lizard, double Jade Lizard. Let's get into these spreads one by one. Debit spread. Why do we call debit spread? And you can do it to the put side and call side. Let me go to the Sensible tool. Okay, this is debit spread. You can see the risk reward is very good, and in the part 2 we'll see how do we achieve this risk reward by going little out of the money if our view is trending. Like if you have a trending view, we are going for the debit spread. Why debit spread? Why do we call the debit spread? Because we are giving more premium to the seller than accepting the premium compared to this premium that we accept from the buyer. Okay, this sell, what we sell is less and what we buy is more. So let's see, when do we go for debit spread? See, there is a some very negative news or positive news. Say there will be a negative news. Generally, that's what happens, right? And there is a strong support, and there will be some small supports. Again, you see very strong support. This is a 17K, and this is like 17 16.5k, and this is a strong support. When there is a negative news, market will come down without seeing any resistance, and the breakout has happened here. So what do? Do you sell call because the premium once they decay, that's all the your profit is. So for example, if you have sold it for 100, so maximum you can earn is 100 with the selling call. But you know there is some negative news and it broke very important support. I am going to buy put, because there is no limit. If you buy it for say 100, it can grow 200, 300, 400, okay, or even more. And another case, you are earning from this, say if it becomes 400 at that point, by the time it reaches, and you see there is a strong support and the effect of the news is no more, effect is no more. And you see after maybe after 2 3 days, there is a strong support and the chart started accumulating. Bank Nifty or Nifty started accumulating. You can do it for any instrument, whether Nifty, Bank Nifty, or any other option, stock options. At this point, what you do, you want to earn this range also. You don't know whether it going to break out or not, but high probability that it is going to accumulate till the expiry. So simply I go and sell put, and this become complement. Capital required for this is very low because we have a hedge already. And if you sell it for say 60 or 70 or 150, say for example, and this has by become 400, and by the time it reaches here it would have become 75, and till the expiry it is like accumulating, it's a range bound, and this becomes zero. That means you earned how much from the buy? 400 minus 100, 300 you earned from the buy, and from this option selling you earn 150. So totally your earning is 450. If you had only buy leg, then it's 300. Since you have buy and sell, your profit is increased to 450, even though it is range bound. So that is the advantage of having this hedge. That's what we have exactly done. So if you think this is breaking, it has broken some support, that's why you buy. And at 16,500 there is a strong support, and you want to increase this profit, you are selling this and you are earning from this also. This is called debit spread. And you see the risk reward. This is very good strategy. You can also say this is buying strategy, not the selling strategy. So this is option buying. Okay, so your main focus is on buying, and to improve your profit you sold it from far OTM. Okay, next topic is credit spread. Why credit spread? With the option selling, you're taking more premium compared to what you're giving by buying the option. So you're giving less premium and you're pocketing more premium. That's why this is credit spread. So why we go for credit spread, and what scenario we go for spread? Say you have a market view that market will be range bound or slightly bullish. Say it started from here and you think it's going to be range bound with this are slightly bullish, not breaking out, breaking down. Or if other view is like slightly bearish and range bound. So in this case, what a wise decision is, in this case, if it is slightly bullish, sell put. If you have sold it for 100, if it is slightly bullish and range bound, it will become zero and you pocket that 100 rupees. Similarly, slightly bearish, you sell call for whatever premium, or 100, 150, 120, whatever. Slightly bearish and it is range bound, it will become zero, you pocket this. That's the idea of credit spread or selling option. So what you do to get the better margin, you also hedge it. If you sell call, you hedge it with the call buy. Sell put, you hedge it with the put buy. That's what we have done here. But risk reward ratio will be very bad here. So we should have a strong, view that it going to be range bound or slightly bullish. And the capital required is reduced to very good extent with the hedge. Okay, you can go a little away also to have increase this profit margin because you have a strong view of range bound or slightly bullish. This is debit spread. Another important strategy is ratio spread. Why do we call this ratio spread? Because we will have ratio of 1 is to 2 or 1 is to 3 between buy and sell legs. So we have 1 buy leg, 2 sell legs. So this is 1 is to 2 ratio. You can also do it for 1 is to 3 based on various market views and condition. And if you do that, the profit here increased, range also increased, or maybe it just a lifting. We will see in the real time, back testing and what basis we do this. For now, let's have 1 is to 2 for learning. So here on what view you go for ratio spread. Say for example, your view after 1 week market comes to some this point from here, and this is the maximum profit zone. It expired somewhere here. That is your view, and you don't want to take a risk if it continues to go down. You don't want to lose money. In that case, you create the ratio spread. Okay, and we know some techniques. How do we increase this profit if it continues to go down? We can keep shifting this maximum profit zone to the left as the market goes down, and also we can lift this area by selling more premium. More lots are increasing the premium within these two lots. Okay, and another view to create this. Say for example, you have a debit spread, and at one point your view goes wrong and market starts reversing. You don't want to give loss, and you want to convert this loss area into profit. You simply go and sell one more lot of this, and you see this loss converted into profit, and let the market go wherever it wants. We can increase this profit by shifting this maximum profit area to the right, or selling extra premium and lifting this area to the maximum profit, or increasing the profit in this zone. So this is another view, converting from spread to debit spread to ratio spread if your view goes wrong. And I'll also explain Jade Lizard with the same debit spread. One view, when our view goes wrong, I will simply go and sell extra, put from the upside, so that I this profit, this loss side becomes into profit. But you also want to be more safer for the reversal. So go and sell low delta for OTM options, so that on reversal this will not have much impact. You will have a time to exit out of it. So now you see the loss side is converted into zero loss or slightly profit, and on reversal this will have less impact compared to the other closer sell leg. And you can go little far away. You can play with this. You can go far away or you can come closer. Okay, so this is one view. When your view goes wrong, you can go for this jelly lizard, and other type is you can simply create J lizard. This strategy initially itself based on your view saying that okay, so market may reverse and can expire in this particular range, but I don't want to take a risk if it continues to go down. So it is similar to ratio spread, but you will have a range in the maximum profit zone. That's the difference between ratio spread and Z lizard. And we have also seen how do we convert debit spread into ratio spread or Z lizard based on our view or when the market goes opposite to our view. Now we will see what is double ratio spread or double J lizard. Okay, when do we go for double ratio spread? Okay, let me come to the notepad. So there is a support and resistance, Nifty or Bank Nifty or any option is playing within this range, and at expiry you have a doubt that either it comes to the support or it may play in the support or resistance zone. This is resistance and this is support zone. You have a strong view that it can either expire here or expire here, or maybe if you have, you can start from spread and your view goes wrong and you convert that into ratio spread, and you have a view it's going to play in this range, and the expiry may happen at the border. So your view continuously keep on changing. Your starting point is debit spread, you converted to ratio spread, then to double ratio spread. That's another view. Or initial view, you have a certain range and then it can expire at certain boundaries of this range. In that cases, you can go for the double ratio spread. And there are some other reasons also, but these two are the strong reasons why you go for double ratio spread, and you will get very good range and very good probability to gain the profit in this doubles ratio spread. So I've done it multiple times, and this is very rare it fails. Most of the times you gain the profit. And if market continues to play in this range and expiry is closer, you can shift these two maximum profit zones closer and you lift this middle area to higher profits. You can do a lot of adjustments with this. We'll see in the part 2. Similarly with other strategies also. How do we increase the profit? How do we convert loss into the profit with the out of box adjustment, advanced adjustments? We'll see that, and I'm sure it's going to be easy for you guys. Similarly, the double Z lizard, it's the same concept, but we have a range here. Instead of this maximum heap, we'll spread this maximum profit zone little wider. So that's the difference between double ratio and the double Z lizard. There is nothing much. You have a bigger range here, and you have a bigger range here, and even in this bigger range the maximum profit areas is more here compared to the ratio spread or double ratio spread. The profit is slightly reduced in that the maximum profit, but we have more range. Okay, that's the difference. Okay, these are the different strategies. So I think we have discussed all the 6 strategies, and coming to this, we have seen when to take which spread, how to create the spreads, capital required, and if you want to hedge the unlimited loss side, I mean this side, if you hedge these legs, the capital required will be reduced further. Okay, and what else? We have seen how do we convert one spread to another spread when our view goes wrong. Okay guys, I think that's all for today. I hope this video is very useful. We'll see in the part 2 with the back testing. We'll see the advanced adjustments and out of box adjustments, and we'll also discuss the game rules before we get into the simulation, so that it'll be easy for you guys. Thank you for watching guys, and like, subscribe. We'll see in the next video. For now, bye bye.